Hi, this is Gletzmar B. Kasama and this is the GBI Accounting Lectures, where we offer understandable accounting and auditing lectures. I know, most are claiming that, but let's break it down. Our lectures are understandable because they are non-technical in nature and we use simple English in explaining. Aside from that, the lectures are storytelling and point of view based, which means we are to step in different personalities like creditor and debtor or lessor and lessee to encourage your imagination. On top of that, we will be using a lot of illustrations and examples. We will also be focusing on concepts and answering the question why instead of hows. The lectures are also designed to let you relate even if you didn't know anything about the topic. And most of all, the lecture is straightforward, meaning every sentence and every line is important and nothing is irrelevant. Also, we will also try to include all the twists of the topic. So, what are you waiting for? Subscribe and hit the notification bell to be updated on my videos, and let's start the learning. Let's have analytical procedures. Actually, analytical procedures are just procedures used to find out account balances with relationships which are unpredictable. To understand that, for example, if you are to find an entry which is debit expense and then credit income, what will you think? It's unusual, right? But even if it is unusual, you cannot conclude immediately that it is wrong. You still need to investigate those accounts with unusual relationships because there are times that those are actually correct and explainable. Actually, in my example, debit expenses and credit revenue is actually possible. If we talk about not-for-profit organizations which are receiving services from someone like lawyers or CPAs for free or as a donation. So the concept of analytical procedures in simple terms is just finding the unusual transactions and investigating them. It's as easy as that. And since this procedures focuses in unusual transactions, account balances with predictable or reasonable relationships are not investigated further. But if you wanted to be more technical, analytical procedures is actually a process of developing your expectations as a practitioner and then comparing those expectations with the actual data. And if there are significant differences, then investigate further. Later, we are going to have to apply this in sample scenarios or illustrations. But before that, let's talk about how are we going to develop these expectations. Expectations can actually be derived from paint. It can be developed from prior period financial statements. Like for example, the current year is 2021. Then you can study FS from 2020, 2019, 2018, and backwards and develop your expectations from them. A is for anticipated results like budgets or estimated future financial statement amounts made by the company. It can also be a source of expectations. Expectations can also be extracted from interim financial statements. But what are interim financial statements? Those are financial statements covering less than a year of transactions. Like for example, we have quarterly or monthly or semi-annual financial statements made by the company. And lastly, expectations can also be derived from non-financial information and your technical knowledge and skills. To make your learning complete and concrete, let's apply it to situations. Let's start with an example related to these three. Example, the prior period sales is 1 million and the cost of sales is 500,000. This information, let me make it clear, can also be extracted from these two, the anticipated results and interim financial statements. But in this example, we will assume that the data comes from the prior period FS, okay? So let's continue. If the current year sales is 1.5 million and the cost of sales is 1 million, is the current cost of sales reasonable? That's the question. Now let's have the first step in the analytical procedures, which is the developing of expectations. But how do we do that? Most practitioners will make use of different techniques, like for example, ratio analysis. So let's use that. In this example, we have to get the cost ratio of the previous year by comparing or dividing the cost of sales with sales of the previous year as the basis. So 500,000 divided by 1 million, and we will get 50% as the cost ratio. So in developing expectations, we need to ignore this actual current year's cost of sales right here and apply this 50% cost ratio with the current year sales. So 1.5 million times 50%. So our expected current cost of sales should have been 750,000 and not 1 million if the sales and cost of sales relationship of the previous year was maintained. So that is how you develop expectation using prior period FS, anticipated results, or interim financial statement amounts. And of course, that is how you use the ratio analysis technique in developing expectations. So there are a lot of ratios. So if you want to master ratio analysis, I have a link on the description which will lead you to my financial statement analysis part 1 lecture. Now let's go to the step 2 of analytical procedures, which is the comparison of expectation versus the actual amounts, which is 750,000 versus 1 million. And if we're talking about cost ratios, we have 50% versus 66.67. And then the difference is 250,000 as to amounts, and as to the ratio, we have a difference of 16.67%. And the question is, are the differences significant? Answer, yes, if we're only going to base on the available given information in the illustrative problem. But if it's given in the illustrative problem that the company's cost of sales and sales are usually fluctuating due to, for example, changes in the market prices of the product or the prices of the inputs necessary for production, then maybe the difference can be not so significant at all. However, since that information is not provided here, then we can conclude that there is a significant difference, so the difference shall be investigated further. Sir, how about this too? Non-financial information and technical knowledge. How do we develop expectations from this? Okay, let's start with non-financial information. What if you as the practitioner sees that there are a lot of employees getting fired from their jobs, or the turnover or changing of employees is very fast? Or, this might be exaggerated, but what if you witness that the company employees are destroying their personal computers and documents because of the upcoming audit by the Securities Exchange Commission, just like in the movies? And you also have noticed other non-financial signs of bankruptcy. The question is, what will be your expectations related to the company's income in the financial statements? Of course, you should be expecting that FS should show huge losses, right? But what if you saw their FS having large amounts of income? Is that a significant difference from your expectation or observations? Clearly, yes, right? So you need to investigate further. And lastly, related to the technical knowledge, what if you saw that an interest expense is recognized even if the company has no liabilities recognized in the FS? Isn't it weird? Is this a significant difference from what you learned? Yes. So again, investigate further. So that's analytical procedures for you. And if you understood the concept and application of this, you will be able to detect unusual relationships and fluctuations, which sometimes can lead to discovery of corruption and fraud. So that's it. But before we end this, please remember this too. Number 1, analytical procedures is a must in a financial statement audit, specifically in the planning and the completing the audit stage. And number 2, analytical procedures is optional in the substantive testing stage, or in simple terms, the stage of actual evidence gathering. So that's it.